And we're back, episode 208, special episode today. I know people expect to ask us anything on Saturday morning. We actually got an even better episode. We got a deep dive with our good friend Scott from Contrarians Capital. If you want to sell your business, you're looking to buy good businesses.
Yeah, that's right. 1 to 2 million, 1 to 10 million in revenue. Mostly we're looking at software companies, technology services businesses.
And your record has been pretty good. So what kind of returns do you generate for your investors?
Oh, well, actually this past month since I was last on, we locked in a 10 kind of first 10 bagger. So
10 bagger.
Pretty happy
Amazing.
with that one, and that's a really active investment, not a passive one. So
great.
Very happy with that one. Yeah.
Fantastic.
Incredible. That's why when you buy good. So do you think money's made on the buy or the sell? What's more important for you?
Oh, definitely the buy.
Yeah.
I totally agree with that. I think anyone that is involved because effectively you are trading, but there's a lot of value add that goes on in the middle, and you don't necessarily want to sell. But I think when you buy a business or a product, if you're a trader or whatever, that's when you know whether you've made money or not, really. Mostly as soon as you buy it, you're like happy or sad. The sell is just the way you get your money.
Yeah, and there's so many different variables in the world. You just never know if you're operational. No matter how smart or brilliant you might think you are or you are, it's hard to drive operational outcomes in a lot of ways. So
yeah, definitely.
Well, to get a 10x result in this market is pretty incredible because it's not a great market for asset sales, and obviously it's tough out there. So amazing result for you and your team.
Yeah, I think more importantly on the weekend, the Kangaroos had a tear-jerking win.
Weekend,
so that was actually more emotionally moving. The other one had the spreadsheet going. I don't need to live in Melbourne to support the Kangaroos.
Well, that's good. I'm all in favour of people supporting all sports and pumping their money into them because ultimately it flows through to the people that supply technology to the teams.
So we're here to obviously deep dive into business, and we're deep diving in one of the most volatile stocks on the ASX today, actually, tech business SiteMinder. SiteMinder is essentially a B2B SaaS product for hotels and accommodation providers. But lots of listeners probably wouldn't have a clue what SiteMinder does, or may have not even heard of SiteMinder.
It's a great kind of business.
It is. And we obviously at Luxury Escapes work with SiteMinder, and its chairman, Pat O'Sullivan, was our chairman. So I know the business really well. Les Letsky, who was this angel investor, I think he's sold out completely now.
Well, we spoke about it a little while ago. I forgot about it, but I remembered as I was just looking at like the shareholder movements. Basically, I think he sold his 15 million shares for more than $4 a share.
I think he got more than that.
Maybe
I thought he had 100 mil. I thought Les took 100 mil out at least.
I think we spoke about it. I can't remember.
Yeah.
Whatever it is,
It was an incredible
he took
investment.
out a significant percentage of the current market cap.
Yeah. Well, remember, he was one of Australia's best angel investors.
He is. I think he might be the best angel investor.
And he invested not day one, but pretty much day one in this business, and he effectively guided them from day one. Effectively, Jack Champ, much like what you do with your investments.
Was he the exec chair of that business?
I'm pretty sure he was exec chair. Okay. We've acted as an exec chair.
Well,
with
Mike
advice.
Ford was running the business.
Yeah, exactly. Mike was running. So essentially what SiteMinder does is what's called a channel manager. And so we use it at Luxury Escapes. If you don't own an online travel agent, you probably don't know what channel managers are, but you've probably used one indirectly when you buy, if you've been to Booking.com or Expedia or Luxury Escapes or any number, or Trip.com or Airbnb, you've used a channel manager. Effectively acts as a traffic controller between a hotel systems, what's called a PMS, and travel booking websites like Booking.com.
Well, I assume that PMS stands for Property Management System. Is that what it stands for?
Yeah, but it's actually... In hotel land, it's a hotel management system.
Right.
Same. I think as an outsider to the industry, I thought it was a hotel management system.
So PMS or HMS is like Oracle's the biggest one. So Oracle with the big database provider. So you've got a hotel. This is room 121. Adir's in that room today. This is not F&B. So it's a way to manage like a ERP for hotels in many ways. So what SiteMinder does is it gets that ERP information and then spits it out to all. You could have 50 different OTAs you work with, and problem is, let's say you're on Booking.com and Expedia, you got one room left in the lead category.
Yeah.
If Booking.com sells it, you need to straight away tell Expedia. Otherwise, Expedia will sell it. Adir and Scott rock up to book check-in. Only one room. So that channel managers became really critical about 10 years ago.
You tell me if I'm thinking about this the right way.
Yeah.
So I own a hotel, and some people are going to book. And so I've got some software inside my hotel that runs my hotel.
Yeah.
That's the PMS.
Yeah.
But now I need people to book my hotel.
Yeah.
And so some portion will book directly. But if I'm a boutique hotel, probably most people are not going to come and book directly. I'm going to have to use third-party booking channels.
Okay, the direct stuff I'll talk about in a second because that's also relevant here.
And so the problem is I need to find a way to pump my availability to all these different online travel agents.
Distribute your availability.
And I need to have real-time information that updates when it gets sold anywhere. And I might also want pricing parity across all of my different
you very much want pricing parity for your hotel.
And so I need plumbing that pumps it all in there and a smart system that takes all the information going backwards and forwards through the pipes and keeps it right.
Exactly.
And that's what this business
the other thing you can do is also you might want to do a special. So I might say if you check in 4 months' time on this weekend when I'm quiet, I'm going to give you a $30 discount or 20% discount. And they can make those discount, create what's called a rate plan, and then all these different online travel agents can pick up that rate plan and get the discount. So it's a way to really manage your inventory with third parties.
Yeah.
You can't, obviously, if someone's booking, if you sold 100% of your inventory directly, you don't have a need for SiteMinder, but no hotel sells 100% of inventory directly.
Or if you've got, so you can tell me to stop talking if you're going to talk about this, but or if you're a big chain like Marriott, you might have your own version of SiteMinder.
So all the big chains have to
Oracle or something.
They all use their own PMSs. They've also got their own. So Marriott's got their own system. Accor's got their own system.
So they're not using SiteMinder.
No, they use something called Derbysoft, which is a enterprise version of SiteMinder. So SiteMinder specialises in smaller hotels and resorts. You can be like a 30, 40, 100 key resort, but if you're a big chain with hundreds of resorts, you use either what's called Derbysoft or Synexus. Derbysoft is a bit different, it's a bit of a switch, but Synexus is effectively a bigger version of SiteMinder. Used to be owned by Sabre, the big airline.
Oh, I remember I used to deal with them.
Yeah. If you're an airline, you
it was them and Amadeus that were the big competitors in the...
Amadeus Sabre are the two big ones. So they do that for airlines. So we work with Sabre, for example, and Sabre gets us the pricing for airlines. We used to be Amadeus. So SiteMinder and Travel Clicker kind of handle that sort of mid-low market.
Travel Click's the Amadeus one or the Sabre one?
Sabre's Synexus. Travel Click is owned by someone else. It's independent. So if you're like under 200 keys or not a massive brand, you're probably on Travel Click or SiteMinder. If you're a kind of Shangri-La, if you're a Peninsula, like a kind of a mid-size in terms of keys, you're probably on Synexus. And if you're a big chain where you've got your own massive system, like Accor, IHG, Hilton, Hyatt, Marriott, you're probably on Derbysoft. So, but essentially those four things, and there's a bunch of other smaller ones.
I saw the Hyatt was listed on the SiteMinder integrations.
SiteMinder could be Hyatt. Oh no, actually no. I think they use multiple. Often they use multiple as well.
Maybe they're like, Hyatt's got so many brands. Maybe the more boutique
the franchising ones. Sometimes the
franchise. Isn't Andaz Hyatt? Or that might be a big brand.
That's bigger. I think Hyatt used to be SiteMinder. I think they may be because we just linked up with Hyatt, I think via Derbysoft. It took like a year because they're massive. So as an OTA, by the way, this is a great barrier of entry for an OTA is you can't just rock up to Hyatt or Hilton or Marriott or Accor and say, give me a connection. They'll say, they'll laugh at you and tell you, wait in line, wait 10 years. So you've got to be of scale because there's a tech burden on the hotel to connect even via a SiteMinder or a Derbysoft. So there's work to be done on both sides.
So there are lots of, so the way I think about this is it's smart plumbing. And there are lots of industries.
Piece of middleware.
Yeah, middleware. And there are lots of industries that have this. If you're a mortgage broker, you can't just sign up to banks. Actually, there's an aggregator that sits between that has all the deals with the banks, and then you sign up to an aggregator, and they often provide software to run your business and whatever else. And so what I thought was fascinating about SiteMinder that I hadn't realised is I knew that they were targeting the smaller size hotels, but I was shocked about how big the market is. I think they said there's like 700,000 of these things or some ridiculous number like that around the world.
And a lot of the hotels don't have integrations. A lot of, most hotels would, like a lot of smaller B&Bs don't have. And what the other thing SiteMinder's done in the last sort of 5 years, which has really supercharged that business is they've also now a transactional website. So we talked about how you can go to hotels on website. So what SiteMinder really smartly did, I know it was 5 or more longer ago, they said, why don't we'll also build you a website and we'll allow you to transact and you can control your rate plan. So we'll create kind of a mini PMS for you. If you're a small, you're not going to put Oracle in if you're a 5-bedroom B&B, but I'll definitely put SiteMinder in. So the beauty of what SiteMinder can do now is you create your PMS on SiteMinder, your rates, you can sell direct, it creates your website. And we actually briefly used it for our old accommodation business when we ran an accommodation business. And then you can also link that into third parties like Booking.com and Expedia. So it really creates sort of one-stop shop for transactional and for middleware.
Don't they have... It seemed to me there's two different levels of product. There's SiteMinder, the channel manager with all the payments thing, which clicks into a lot of the other PMSs. But then they've got their small boutique.
That's exactly
little
what that
hotelier.
Yeah,
is
exactly.
The small,
that's the
small
transactional.
one.
That's kind of like the Shopify.
Yeah, the small one.
That's a good way to think about
it.
And
I think it's something like 650 integrations, which is huge compared to their competition.
Yeah,
the number of systems they've connected to is you're not going to. Hyatt doesn't want to go build that many integrations.
No, 100%.
An individual hotel definitely is not going to be able to, even if their vibe coding isn't going to get there.
Generally, I think this is very hard to vibe code, this business. And they're quite entrenched in that.
Well, it's also, I think,
we'll get there.
This is a relationship business as much as a software business. When I look at this, like it's hard to. So my summary of everything that you said from an economics point of view is this is a business that for its early and middle life, like let's say we're in late life today, but it's got a long time to run. But until this moment, early and middle, it was predominantly selling subscriptions, and then it brought in this I'll call it usage-based pricing, where it has this other stream of revenue that goes up based on the transactional volume.
Takes a clip, essentially.
Which is a bit like
Fresher, the business that I'm an investor in that recently raised at $1 billion valuation, does the same thing for beauty booking sites. It makes its money off the arbitrage with how much it charges on credit card processing, essentially, which is what these guys. So if you look at in their P&L, there's a big chunk of money which is transactional costs, essentially, revenue, which is them paying the credit card processor, and they're making a nice little arbitrage on that.
Which, by the way, is Shopify's big part of Shopify's revenue.
It's more than just there's a bit more to it because they're also taking a commission on some of the smarts they do to identify and sell in different markets.
And in April, SiteMinder claimed that it will launch new AI tools to convince investors to halt a dramatic sell-off. As part of its product upgrade, the company announced a new partnership with Direct Booker, an AI startup founded by former TripAdvisor executives, which will feed live hotel data from SiteMinder into the AI platforms as well. MA technology analyst Sinclair Curry said the AI threats facing SiteMinder were overstated, and it was unlikely hotels would start vibe coding their own alternatives just to save a couple of $100 a month.
It's so ridiculous.
If you look at your Adir's famous pyramid of churn, or whatever you want to call it, to vibe coding, this feels pretty low on the list.
Yeah. It's hyper niche.
It's very cheap.
Selling to people that are not tech companies.
Super high switching costs.
To give it some, there's a great framework I came across from a venture capitalist in the States around AI, like your 8 moats around AI. And the 8 moats are workflow, data, scale, ecosystem, regulation, distribution, network, and physical. When I look at this business, like the ecosystem that it has with those 600, 650 integrations, like none of the large language models can do that because you've got to go and sit down with someone from Hyatt. You've got to go sit down with someone from relationships. You've got to get access to the API.
Well, they've got, if you look at the number, they have hundreds of thousands of hotels on there. So look at the number of hotels specifically. It's like
and then
crazy.
all the PMS systems they've got to connect to.
We agree.
There's so many different systems,
I think those 8 are like almost identical to the 8 that we talked about. I think everyone's coming to kind of the same conclusions about AI. Yeah, I agree with that.
SiteMinder's volatility has been absolutely crazy since it IPO'd in November 2021. Obviously, IPO'd a heap of COVID mania at $5.06 a share. It was valued at $1.4 billion when it IPO'd. The share price then leapt to $7.10, so straight after, which was unbelievable. Then dropped back to $2.96 a couple of years later, so it sort of dropped by 60%. They had a massive comeback, hit $7.68 last October. So this has really followed some of the vicissitudes in the market. So it was valued at well over $2 billion at that point, or it was $2.2 billion, and then it got smashed in the SaaS apocalypse along with everything else. It's now worth $796 million, actually an all-time low, bizarrely, as a listed entity.
This is why you can't let the stock market shape your sense of self-worth.
Let's go into financials and
Can
growth.
I say something about the IPO?
Okay.
And pre-IPO versus the $750, $800 million valuation today. So at the IPO, it was worth whatever you said, $1.4 billion.
Yeah, it's just after.
There was like $500+ million taken off the table at the IPO by investors. If you add Les's sell down to that, Les Zekeli, I mean, they're almost at 1 times their market cap on sell down that's happened by insiders on this business.
IPO and then sold down the rest later on.
Yeah, and I think that if you look at it, like this business at IPO was trading at like 12 to 13 times revenue. Yeah. And now it's trading at 3 times revenue? So there's been a huge revenue.
It was 2022 though.
End of 2021. No, I know, but like
that's probably cheap in that.
There's been a huge
SpaceX 100 times revenue, which we'll talk about next week.
There's been huge margin huge multiple compression on this. What's interesting is that in 2019, got this vague recollection that when they raised money in 2019, the valuation is like the same as the current valuation.
Yeah,
like I think they raised it like $750 in 2019.
Yeah, that wouldn't surprise me at all. Pre-COVID,
they basically, and that's pre-COVID.
Yeah,
and that
this business was harmed slightly by COVID initially because remember it's an accommodation business, so bookings went to zero.
But that 2019 would have been a business on an upward trajectory.
Oh, 100%.
And so you effectively are buying a business today with probably 3 to 4 times the revenue of 2019 at the same valuation as 2019.
In its half-year report lodged in February, the business reported revenue growth of 26%, and it grew. So remember, it's got two very separate businesses. The transactional, called the Shopify business, grew 39%, and the middleware business, which is the original SiteMinder business, the subscription platform, grew 18%. Properties on the platform grew 12%, which means the business is driving some pretty good expansion revenue in there. Churn was only 1%, which goes to that point, which is crazy low.
I don't agree with you that churn was 1%.
That's what I said it was.
A month.
Oh, was it a month? I presume that's a year.
It's a month.
Okay, so whatever, 15% a year, whatever that is.
Yeah.
That's still not too bad. That's probably hotels just going out of business.
I thought hard about why would you churn off this platform, and the only reason I could come up with is you go broke.
The odd one does switch. We do see hotels switch, but it's rare. Yeah. Like it's very rare. Someone goes from TravelClick to SiteMinder.
Because lots of little hotels and B&Bs go broke,
yeah,
right?
Exactly.
Just on the transaction, you got more, you want to... You got more.
He's he's always got more.
Actually, I'm not sure that's the transaction business and the subscription business are separate. I see like they're very interlinked, and the way they talk about them too is the transaction.
But the revenue growth is separate.
Is add-on revenue. They grow.
Transaction
at
business
rates.
helps the subscription business because it kind of adds even more switching.
It's not. It's the same business just with another product line. How I think about it.
I think how it is there's businesses who are on just subscription, and there's businesses on transaction and subscription. So, like, you're not going to be on transaction and not on subscription, but you can be on subscription, not transaction. Like, there are some bigger...
Exactly.
There's some people who use
that's
Oracle.
Where their growth opportunity still lies, I think, like just selling out the base to add more and more people onto the transaction.
Yeah, and also just as new hotels open up, they jump on someone. Like Shopify, it's the Shopify of hotels, essentially.
Well, I'll tell you the bear case of subscription revenue because it is growing beautifully and there's lots of good things about it. But the downside is it increases the exposure of this business to the economic cyclicality of travel, because if you're getting a clip of transactions and sentiment goes negative...
What's the transaction business?
So I thought this too, but in COVID, the subscription revenue held up.
Yes, I agree. We agree with that.
He mentioned
we're agreeing.
Yeah. And so, but what's interesting about that, the more I thought about it, because it's a bit counterintuitive, I would have thought, all right, your hotels, you got no one coming in. But I think for those that everyone wanted to still make money, and you're not going to go shut off. Like this
no one cancels these
This is the thing bringing revenue. Like this is the thing bringing money in. Yeah, this is the thing bringing money in the door. You're not going to go.
Oh, so you mean transaction stuff?
No, I just meant I meant subscriptions.
Yes, we're in agreement on that.
Yeah.
The crazy thing that we experience with Catapult. Remember, people stopped playing professional sport. Stopped. Who could ever imagine that? And like for years, I used to say Catapult's essential for teams, but like I didn't know if that was true. I mean, it's a good narrative. And then in COVID, no one was playing sport, and nobody cancelled their subscriptions. And I'm like, they fired staff and didn't cancel the subscription. I'm like, oh my God, I was telling the truth the whole time. So there you go.
The CFO was too busy and forgot to cancel the credit card.
Well, I think the same thing with SiteMinder, which is if there's a piece of software that you subscribe to that is essential to your organization running, you don't get rid of it.
This one's bringing revenue in.
When you resubscribe, there's going to be a cost. You have to, so revenue per user was up 23% for a transaction business. Let's call it transaction business and subscription business. So the transaction business is the credit card business essentially.
I agree to disagree.
And the sub business essentially is the
what do you disagree about?
I don't think they're separate business. They
report it separately. They report it separately.
Right? Yeah, it's the same. They're so interlinked as products. So the thing that keeps the subscription sticky is the fact that I can add payments.
I'm not denying they're interlinked, but they are two very separate
What Adam is
lines.
saying, which I agree with, is this. They had a subscription business.
Yes.
That's all they had. There is growth out of the subscription business.
Much slower.
But that is not the growth they were promising at their exciting IPO, okay?
Yep.
Now they've brought this transaction business in on top of the subscription business. That part of their business has been growing like a rocket.
Yeah, I just use the word product instead of business. That's my only... nuance to what we're saying.
All right. Well, we can say it's a separate product.
Same go-to-market.
How about we say business line? That's what it is. It's a different business line.
Yeah. Because it's the same go-to-market.
The reason why I think it's different.
We're all in violent agreement and arguing semantics. We all agree on the business.
The reason why I differ with you slightly, though, Scott,
what we do on this show?
is so we work with the subscription business. So we connect price, but we compete with the transaction business because they can sell directly.
Could you elaborate on that?
So let's say we're selling, I'm trying to think of a business that's 13th Beach Lodge in whatever. Let's say we work with Jackalope. I'm not sure if Jackalope on SiteMinder. Let's assume they are. So we work with Jackalope, so we connect to them via SiteMinder. They feed us their inventory. We'll sell through a direct connection potentially, and we'll sell down. We'll pay the money and whatever. They will also sell on their website directly. A customer can go to Luxury Escapes or can go to jackalope.com.au. If they go to jackalope.com.au, they're using SiteMinder's transaction business. If they go from Luxury Escapes, they're using SiteMinder's subscription business. So yes, if they're using the transaction, they can be using both. But we sort of compete with one business and we're partnering.
You've got your own transactional.
Yeah, we're a transaction business.
And that's really helpful. Isn't part of the Smarter Pay platform, the whole AI platform that they're rolling out, though, that even in that situation, they can be recommending and still finding you better revenue opportunities? Isn't that part of so even with what you've said, like they're not necessarily clipping the transaction from a payment processing standpoint, but they're maybe getting a commission because they help find you or someone else to move the stock.
But the traffic comes from us directly, not from Google, not from them.
Also,
they're not really directing traffic to us.
We're believing in AI now. I mean, I would fall off my chair if there wasn't a tennis injury risk, but basically, why are you believing in AI?
You can remove the AI. Why are you believing in smarter things of recommending stuff?
You look at their presentation, which, by the way, I don't want to be critical, but that presentation, you read you see their investor deck? It burnt my eyes out with the quantity of information on every slide.
I just read the boring.
So I read that first, and then I read the investor deck. And the investor deck, I don't think they're doing the business justice with that investor deck.
Well, the share price seems to agree with you, Bob.
So this is something I wanted to ask your views on, Adir, because you must sit around thinking about what metrics are we going to put where in our opening when you're doing your annual report or a half yearly report.
Sure do.
I thought I got a bit excited reading this one because I was like, finally there's some decent SaaS metrics in the opener,
metrics did you
not people misdirecting things.
Yeah.
The LTV to CAC ratio was nice to see.
I love how they put that in. I don't know if it's right, but I love how they put it in there.
I like that. That's it.
I everyone puts it in. Why you believe that?
Not everyone puts it in. Not everyone. A lot of people.
Well, we've put it in for a while at Catapult. Other people put it in. Why you believe that?
Well, no. My question to you is, how do you're sitting there thinking about what to put in the Catapult report. How do you decide what goes in and what doesn't?
Because we put it in because we think you think it's good, and people like and
you
people
haven't
like
called me
you.
yet to ask if I think it's any good.
I know what you. I know what you like. No, I tell you what we think about that, because one of the questions is, what do you need to spend so much money on with sales? Because for B2B businesses, it's more sales than marketing. And the answer is, we have salespeople, but like we get tons more back. It's just back-ended over the life of the customer. And that's a bit of that narrative sounds unconvincing, but when you put a metric next to it, like where you say, this is how much the overall value of the customer is worth relative to how much it cost us to acquire the customer, which is what that LTV to CAC metric is, then you can say, cool, we can compare that to what other businesses say their LTV to CAC is, and then you get an arms race on that ratio. But it's just an easy way to explain an important narrative. That's why that goes in there.
Yep, okay.
What else you like that they put in?
So what else did I like? The other one was showing the different, like separating out revenue. It sounds pretty simple, but a lot of companies will blend their subscription and transaction
so you do like them as separate business units.
100%.
Here we go. I agree. By the way, I think these are pretty honest reporting company in my view.
That's what I get excited when I see that.
Yes, that's good. They break it out. They report constant currency
now,
as well as reported numbers.
So I got very excited, and then I did find myself a bit upset when I came to the way they talk about annual recurring revenue, and then under that they have transaction revenue, which is just not. It's not. And then when you go look at the definitions,
you think that,
and you go look at their own definitions,
I ignore all that
and
stuff.
It says I'm just picking it up because it's important, because it's being thrown in with annual recurring revenue. A lot of software companies
I actually didn't have a huge issue with that.
Hang on,
can you just say what you're talking about? What the hell are you talking about? So I actually don't understand what you're talking about. Okay. So the transactional revenue is sitting under ARR?
When they're in their nice opening bit with lots of great metrics, the one bit that I got a little kind of red mark next to it was the transactional. It said annual recurring revenue is whatever their revenue was. I can't remember, 281.
And transactional revenue is a subset of that.
Is a subset of that, which is not.
Yes, I agree with you. It's not a subset.
And even in the own definition bit, it's no, this only occurs when a transaction takes place.
Yeah.
And I forget the name of the company, but there was an ASX company 2-3 years ago that treated it like this. And then, of course, when COVID happened, everyone stopped sending SMSs and their transaction revenue fell off a cliff.
ARR is an unnecessary metric for this business. They have subscription revenue. You can call it ARR if you want. And they have usage-based revenue. And this is a dream business is a subscription business that jacks up its revenue also with usage-based.
Fantastic.
That's a great. I don't think they need ARR as a metric.
I think
I agree with the ARR point. I just looked at revenue.
Too many numbers. Well, that's one of my issues with the presentation. Too many different numbers. I don't know if you noticed. There's only one dodgy number in their entire non-GAAP metrics, which is impressive because usually there are tons of dodgy numbers.
EBITDA?
What do they call it? Adjusted, underlying, whatever their adjective is before EBITDA.
Just the big one.
So I ignore that.
Community adjusted.
So they love that number. That's a number at the front of their presentation. I just ignore that number. So you should say why I ignore that number.
Well, you tell me why you ignore that number.
Because what they've decided is that a big chunk of their cost of people shouldn't actually be an expense.
Share-based payment.
No, I think that.
Oh yes, No,
they're
R&D.
Yeah, they're adjusted EBITDA.
20 million in R&D.
Yeah, share-based payment.
No, they're capitalising it.
Capitalised. Sorry, sorry. I was going to get to that. That's not hardly alone in this.
So they don't need to pull it out. They don't need to pull it out. So just to explain, so earnings before interest tax. I'm
shocked that you're so aggrieved by this. We talk about Seek and Xero, and you don't seem aggrieved at all. Seek puts $150 million of that dodgy EBITDA as this.
We disagree on how share-based payment should be treated.
No, Seek does the R&D thing, and Xero does the R&D thing.
All right, but I just want to explain.
In Australia, you've got to put share-based in your P&L.
I know, but I want to explain my issue with their adjusted EBITDA and why their cash, they've got this other thing called cash EBITDA.
You got to stop looking at my notes and just saying them.
Oh, you want me? So you can say it if you want. Well, I would just say this. EBITDA, earnings before interest, that means money you pay for loans. Tax, that means money you pay the government to get no services. Depreciation, that means the reducing value of tangible assets on your balance sheet. And amortization, which means the reducing value of intangible assets on your balance sheet. Those things are outside EBITDA because that's what EBITDA means. And one of the things that's an intangible asset on your balance sheet is you employ all these tech developers and they build software, but you can't just expense that software because that software is going to last a while. So it goes on your balance sheet as an intangible asset. And then the way it hits your income statement, profit and loss, is that you just reduce the balance of it on your balance sheet and it hits your income statement as an expense. Okay, fine. But the thing is, that's amortization and the cost of those employees, they don't hit your profit and loss statement. And so EBITDA doesn't include amortization. So if you're going to trumpet EBITDA, fine. But if you're really going to factor in the full cost of what it took to run the business, you got to put in all the money you paid those staff this year
depreciation
that you put on the balance sheet.
Yeah, but that's it.
And so amortization is just depreciation of an intangible.
The only thing I'd say is Xero and Seek, massive businesses, do exactly the same thing, and WiseTech doesn't.
Maybe
they all do it. It's not like these guys are any different.
No, but yes, but just because other people are doing it.
I point out other people, and Adir defends them half the time.
I didn't realise
$200 million of R&D.
I didn't realise I was defending that. There you go. I was asleep.
I think if you're going to trumpet your profitability, then
but I don't think
including this in there has to be in there.
If
you're going to make a big deal of it.
I think it's pretty obvious. You look at a net profit. It's pretty clear.
This one is. Again,
Scott's
so many good things about this business, but this one is very hidden. I had to do a bunch of
this is rubbish.
I found it pretty quick. It took me 2 seconds to find it because maybe I'm used to looking at it because I always look for it really quickly. But
what do you acknowledge that it was pretty obvious to spot that it wasn't included.
There's net profit there, so you can tell from net profit the delta between net profit and EBITDA is pretty much its capitalisation.
So your view on this, Scott?
To get to the amount was a bit of work, but I think I think if you're talking about your profitability and that's something important, then you've really got to include a $20 million a year expense and include that in your
paying people?
For paying people,
the challenge
that goes
the challenge these guys have, I'm not saying you're wrong, but I think the challenge these guys have is when you're making $100 million and you got the $20 million in those extra R&D costs, it kind of doesn't really matter. People kind of just look at it because these guys, because it's such a big proportion of their net profit, and so that EBITDA is why it's so much.
If you're not gonna trumpet profitability, sure, I don't care. But if you're gonna make your profitability,
why is Tech trumpets it? C trumpets it, Zero trump. They all trumpet it. They all do exactly the same thing.
And they're all getting docked. Like,
and
they
so
should all be getting docked.
And that's why they've all been docked.
So everyone's reporting it, but then
I think making a fuss of these guys is unfair.
Okay. No, that's
I want to idea bag his mates from his billionaire mates to see. Give a beer.
Firstly, they're not my mates. And secondly,
guys roll out the Rolls Royces around.
And secondly, I didn't even I don't even recall that conversation, but I just want to be
zero.
I just want to be clear
from day one.
I just want to be clear on these 2 points, which will answer Scott's criticism, which I agree with, and it will. So I think your argument that you just made, I'm shocked about this. The argument you just made is when it's big, then it just blends in. But when it's small, I'm more sympathetic because it makes too much of a difference and it shows that you're not really making money. And so...
No, because they're getting scale, so this will become less and less.
That's a rubbish argument.
No, my point is...
Listen to this noise. That's your argument. That's your argument going into the bin. Your argument's in the bin. Number two. Don't talk yet. Don't talk yet because I'm going to tell you something else, which will put an end to this whole thing. Remember I keep saying to you, they've got too many metrics. So this is a non-GAAP metric, which means the objective of this metric should be to help people understand your business better. And this is a misleading metric, but they have a very honest version of this metric. And the honest version is called cash EBITDA. Yep. You see that metric?
So
that has this capitalized R&D in it.
It's like net profit essentially.
But just that the cash one then as well is problematic because the R&D, I think because of the R&D incentive being included in it. So if you,
I don't really care about that. They do get that money back.
Sure, but I think this mixing up of profitability, free cash.
But R&D is always baked in now, so I'm not sure you can penalise it.
And then bringing it down to the rule of, and then it's
rule of 40
rule of 40.
Yeah. Well, they use cash EBITDA. For rule of 40, they use cash EBITDA, right?
Well, they use two things as it happens.
Yeah, but free cash flow and cash EBITDA.
That's right. I just think...
But I think you're too harsh on that with the cash EBITDA. I thought you were going to complain about share-based payments, but they're not. But that's actually not cash. I'm comfortable with cash EBITDA for this business.
No, but my issue why I take your point on CapEx prima facie, don't get me wrong. But
you take my point on if you pay people, it would be good if you included that as an expense. But think about that's my point. That's effectively my whole point.
But what else
should we not include? Adam would have been in fierce agreement with this one.
Well, I am. By the way, it's a boring podcast. But what the point is, as this business scales, it's not adding people. The people cost is actually pretty steady.
Well, that's false.
Business. False. Not completely.
We don't know. False. We don't know that yet. I hope that's
false.
The case.
It's not false. They're not adding people like they're adding revenue.
No. The LinkedIn chart for employees added is going
their costs aren't the same.
That's false as well.
Up and to the right.
LinkedIn is interesting, but what's more interesting is financial statements, and their costs went up. Their employee costs went up 25+%.
No, that's wrong.
Their employee costs went up 20%.
5%.
They didn't.
It did.
Their R&D costs did. The R&D costs.
If their employee costs, which would include R&D costs, went up 5%.
But you can actually. I should correct myself. You can actually go and see what their R&D cost is because you go and fish through the cash flow statement and you look at how much cost on the cash flow statement was investing in software and intangibles, and what you can see is that is rising. And so I think it's still, and they even in their investor deck, they talk about the increasing cost of R&D, and they say, "Oh, this is good. It shows that we're making a better product." Even they talk. I think it might have risen 31% or some number like that. It was a pretty big rise in R&D costs. So I think that they should not have adjusted whatever they call this thing EBITDA. They should just use cash EBITDA to show what this business looks like, and I'd be very comfortable with that. And that is mostly what they use for their rule of 40 number. Yep. I'm very comfortable with that metric.
So the reason I kind of take issue with the EBITDA one, and it's not, Adam's right, it's common, everyone does this, happens all the time, but it comes down to R&D and the way R&D is treated. So I would like to think that people running businesses and the society we're in are capitalists, but R&D being included above the line as income getting money from the government.
I see what your argument
is actually like you're getting a handout from the government.
This would be a tax offset for these guys. This wouldn't be revenue for them though.
But it's the way that it's accounted for, and it's accounted for correctly because what it technically is a grant. And so it's allowed to come in as income.
Only when you're below 20 million. Above 20 million, it's a tax offset.
Either way, the way that the legislation has been set is that it's a grant.
But these guys aren't paying tax.
What's the dollar value of this,
Everyone's
Scott?
the same.
What's the dollar value?
The dollar value. It's in the I think it's like 10 to 20 million. Because there's 7. I think it's 7. They've got about 7. And then they've got a whole bunch of prior credits.
But I think I tell you what I think. Basically, you're right. That's the truth. You're right. That shouldn't... He's right. It is a grant. He's right. It shouldn't be in revenue.
But it is.
It should be a reduction in expenses. That's my view on it. Because it doesn't. In the end, it doesn't matter. On the bottom line, it's the same. And I take your point. It shouldn't be revenue growth. If anything, it slows down their revenue growth because it will be growing slower than their revenue.
I know everyone's really upset about CGT, but I feel like the R&D, the treatment of R&D on where it sits on the P&L should be another big item up there.
Yeah. Well, that is. I'm not disagreeing with you, but I think in this business, ultimately it comes out of it's going to look the same at the bottom line of cash EBITDA.
Look, yeah, it's more my philosophical position on where it should sit than anything.
I think you're right about that, but your philosophical position should be more passionate about the changes to how leases are structured than anything else. And I think, Adam, you're right. Like it is a tax offset at 20 mil, rising to 50 mil after this budget, and so they're not paying tax because they've got forever losses. And I don't know. I think they're not going to see the cash of this R&D offset, are they?
Oh, not for a long time.
Yeah.
So in terms of that, revenue was up from 104 million to 131 million for the half. So that's good. Pretty decent revenue growth for that. That's great. Employee costs, I think they were steady. You disagree?
No, I agree. I just was more granular than you were.
What was up was credit card processing costs was up $8 million because obviously that's the transactional business. So that just flows.
And that transactional business, if you call that cost of goods, cost of sales, it is reducing their gross profit half on half. Not a lot, but by their gross profit just by 1% every half.
I thought about this a lot. But the thing that it's really increasing is their moat. Like that stickiness of the processing the transaction and just having that extra thing that's even working harder around revenue. Yeah. And so I think it's a great...
Definitely adds their competitive advantages, no question.
Well,
it is obviously make some money as well.
Yeah. So, it is also increasing 3 other things: their revenue, their profitability, and the value of the company. Yeah. That's what it's increasing.
And on that, I think they're at 4,000 or so properties have taken it up.
Is that all?
And so they've still got...
That can't be right.
They must have one number. Maybe it's one of the products.
Incremental.
Yeah, but basically... There's a long way to run. On the transaction one. No, on the new platform they're releasing.
I'm talking about the general, the normal site, little hotel.
Right. Don't they have 53,000 customers?
But I think my point is that this new platform they've launched and they're getting customers onto it. You can see the growth there. They've still got another huge portion of their customer base to sell this into. That's without going for new logos.
As customers keep going.
Yes, which is a great...
It is a competitive space. It is a competitive space. There's other people who do exactly the same thing. They're not the only ones.
If you love SiteMinder, you got your data in there, there must be a good case to switch it.
We get so much in the granularity of this. And my view was so different about this, which is, number one, look at the product. Where do they sit relative to competitors? When I did some research, better. There's Cloudbeds in the US that's raised. You know who they got money from? Cloudbeds, Vision 2.
Oh, really?
It's a SoftBank company. So they've raised 300 mil, but it looks like people are mostly start off with Cloudbeds, and as they grow a bit, they go to SiteMinder.
I've never even heard of Cloudbeds.
I think their revenue maybe is 100 mil or something. They're not small, so. I think, but they don't really...
There's RMS in Australia is another one. There's plenty of these.
But they're not better. None of them are better than SiteMinder. When I looked at, I cheated a bit and got AI to do some review of product reviews of this world, right? And so you look at that, I think their product's good. I think they've done an amazing job of expanding into transactional revenue. They're growing really nicely. They're about to go through break even. Their cash EBITDA is an honest metric. And you look at this and you say... What do I think about this overall business? Well, I think it seems to be run well, although I don't like that Mike Ford is not even on the board anymore, the founder. He's gone off into the distance.
Yeah, he's tired.
So I don't love that, but And Les is off the board now.
And the new CEO, I think the new CEO,
Shankar,
he's like a second founder. Like he's really taken a big I think people think of him as a refounder of the business.
I think he's got like 7+ million shares, so he's very exposed to the business. And so you look at this thing and you say, how could you justify a $750 million valuation? Is it easy or is it hard? And so
I'll just finish my financials before we get
this.
So people know what I'm talking about. So the business famously claimed a EBITDA of $11 million for the half. Of course, take that big grain of salt because there was almost $15 million in software costs. So that's sort of a negative $3 million when you factor that in. A better reflection of the bottom line, which was actually very positive, was SiteMinder reducing its loss from $13.3 million to $4 million. This is a net loss for the half. Yeah. Throughout its life, SiteMinder's racked up losses of $662 million.
Well, it hasn't really. I just want to say that. So those retained losses
some share
have a massive $400 million reserve. If you look at the balance sheet, which I suspect, I don't know, it's hard to get to the bottom of, but it's a bit boring and complicated, but I'll say it in 2 lines. They basically had, I think, convertible notes or something, and as the value of the company rose, the value of those convertible notes that they're giving away rises.
It's like employee equity.
Exactly. And when they actually go and trigger the convertible notes, they're going to wear the cost of that as a company, and that's going to hit reserves. I think they're more likely to have lost 200 or 250 mil.
But my point was more, it's lost all that money now. It's basically a break even. Yeah. So it's sort of been on this journey where it's sort of now at the end of the road.
And if growth kind of continues the way it's going, they'll be posting a profit potentially even this half.
Exactly. Yeah. Although I'm sure they will be, based on what they were saying.
And as long as costs haven't gone up.
And this is a business that just tends to just grow like naturally. Like it's sort of at worst case, you're growing 10%. Like worst case, but really you're probably growing more. So if it grows 20% again, how much money are they making?
Well, I wanted to ask you just about that on the. Oh well, if it grows, if it's just tracking the way it's been tracking historically, they could do 20 million in Scott operating profit.
So real money, real profit.
Like this half, like this full financial year, FY26, and that's just
FY26.
That's just pushing things forward. It's all in the growth of revenue.
What's the Scott operating number for the first half?
I've just got the full year here of 280 million revenue total.
What about the Scott operating number?
Profit.
You're pitching your Scott operating number. What's the first half? So profit NPAT was -4. What's your number for the first half?
This is quick math, but just the revenue that I had them finishing on is 280 million. I'm just saying which
I think is too high, but anyway, it's okay.
It could be. All I've done is roll forward the historicals.
What are you multiplying that by to get to your $20 million number?
Oh, I've got the full cost with the research and development included as an actual cost on the operating profit. But I take your point of like the half, because of the half to date, it's going to have to catch up a bit. Yeah, I think a lot of it's coming from the revenue growth though. Like really all this profitability is it's not coming out of cost changes. It's really coming out of revenue growth, which is there and real. Like I think
there's some slight jaw widening as well. It's not massive jaw widening. There's a little bit of jaw widening going on here.
A little. Yeah, well, they talk about it a lot in their overwhelming presentation.
I don't think the presentation was that bad, by the way. I think you're overly critical of it.
Really?
I didn't mind it.
What, that 40 pages where...
I think it was too bad.
The financial part of it was good.
Yeah. I thought
there was lots and lots and lots of content on every slide and too many non-GAAP metrics that they don't need.
Yeah.
Just went straight to the books and used their website.
I generally looked at the books as well.
I know, but then it's good to see what they're talking about.
Yeah, 100%.
And what they think is important. Look, the way I feel about this business is pretty simple. Like, could you see this? Forget about 26. Let's talk about FY27. Yep. Could you see them generating a $20 to $25 million NPAT in FY27? Probably. They could get there. And suddenly now you're on
60 or something.
Something has to go very wrong to be at 20 in 27.
Yeah, and so then suddenly if you had the same valuation as today, because their balance sheet, just forget about that. It goes to it wipes itself out, right? So that means that if you had the same valuation, when you get to the end of FY26, a few months' time, you're looking at probably 30 times forward NPAT. So 30 forward PE. That's not crazy for a business like this at all.
Maybe even as good as 13 times like FY27.
Well, you're very ambitious.
All I'm doing is rolling forward the growth rate.
So I think it's like you might be right. I think it's unlikely they'll get there, but even if, let's say, they get 20 to 30, all of a sudden this business starts looking very cheap. And so this comes down to like...
when you say cheap, because I like go straight to margin of safety to start with, and then I want to layer on top. And when you say cheap, it's still a forward. Like paying that price today,
I don't think it's cheap
is
today.
still a forward.
I agree with you.
You're paying a forward multiple.
You don't think the current valuation is cheap?
No. I'm just talking just in general terms. Paying a forward multiple, like it's essentially double. So if you're paying today's price for, call it 30 million in profit next year, you're almost paying you're paying a lot more for next year's result.
Maybe you would say margin of
which may or may not happen.
I think you're talking about margin of safety.
Yeah, I'm just talking margin of safety.
What you'd say is it's now the end of May. They're going to report some numbers in July, presumably, and full numbers in August.
Yep.
And so in July, if you see that this year's second half played out in the way you were hoping, the margin of safety increases dramatically for FY27. And I think once those July numbers come in, this might actually look like a very good buy because...
But the way to be a great investor is to get in before that, because when those numbers come in, everybody knows and it's baked into the share price within seconds. So the question is, do you think that will happen?
Yeah.
And that's when we go to first principles and powers and switching costs and stickiness of revenue and churn, all that kind of stuff. I think you can make the call now.
Well, the interesting thing I got to with this was a lot of it's tied into that transactional revenue base, which Adam is probably one of the best people in the country to know where the winds are going on transactional revenue around hotel bookings.
The US looks bad to me when I look at this.
And yeah, so this is the bit that's really
curious.
No one wants to go to America.
Much bigger in Asia and Australia.
Yeah, well, just because if you're talking about margin of safety, there is a world where, because most of that profitability is being delivered through revenue growth, not through cost out. And so you've got to really believe in the transactional growth story. And so I think it really comes down to how real is that going to keep growing, or are we going to get hit with people stopping traveling, stopping making bookings?
So your first principal question is, will tourism continue to expand or not? That's essentially the question.
Yep.
I think
if you
look
12 months.
Look at aging population. So I'm taking my own book because we operate in the same sector. So what's good for them is good for us. But it's hard not to think of travel continuing to grow as older people continue to get richer, and they're the biggest spenders on travel. As Gen X becomes that boomer age and starts working less and traveling more, it's hard not to see travel continuing to go well for businesses like SiteMinder. Anything's possible. If you look at and Graham Turner from Flight has got this great sort of discussion about it. If you look at since 1998, 1999, there's been SARS and there's been GFC and there's been obviously COVID. There's been blips, but travel was like, if you can see my hand, it's a line up and to the right. And it'd be hard to think this reverses. I think these guys have a lot of tailwinds.
I think so. Australia, APAC used to be their biggest market. Now I think EMEA is bigger than APAC. But the US is the one that's actually got decelerating growth. And I think that is mostly the Trump effect of tourists not going to the US.
Well, US tourism has been smashed,
Yeah, I think that they are feeling the pain of that. But Scott's comment is right. As they leverage more to the transactional based revenue, the cyclicality, economic cyclicality as it pertains to travel is going to have more of an impact on their profitability
I totally
than
agree.
as a subscription.
Yeah, subscription that people pay rain, hail or shine, as you both noted. I think you're right.
It's hard to imagine this.
So protection, actually, the subscriptions, you kind of margin of safety, and the transaction.
So you always do a sum of parts here. What's subscription worth and what's the transaction part worth? Because they're intricately linked, but they also are two separate businesses in many ways. So you can very easily value the subscription business because it doesn't churn that much, and what's the revenue? It's not growing that much either. So you can easily model that. Transactions are harder to model for sure because who knows what churns 100%. So who knows what, as in terms of transactions. But it's definitely modelable. This is not the hardest business to model by any stretch.
And what would make it get cheaper from here? There is nothing, the fall in share price is when everyone's share price fell. It was SaaSpocalypse falls. And so that's what took the wind out of the sails basically. And so what could make this halve from here is maybe
let's go ask questions why this was caught up in the SaaSpocalypse, given you've got
because it's software.
Yeah, but
it's the SaaS part of SaaSpocalypse.
So let's think
that means software as a service.
Let me rephrase it. Should it have been? And if you look at the two parts of the business, one is called the actual SaaS part, which has almost no churn. You're not going to vibe code something that costs you $200 a month, and you can't vibe code it because it's actually too complex. So if you look at your 8,
that's great.
This is a safe. So
The market just punished
that should have been
everything,
hit by SaaS.
though.
And then you
The
look
market
at
just punished
the other
everything.
part is transactional revenue, which is not even definitely SaaS that much anyway. It's like a credit card processor,
Yeah.
and Visa and MasterCard haven't been hit. So like, I don't know what this is, guys. These guys essentially like another Visa, MasterCard, or an Amex, all done really well. So SaaS apocalypse should not have impacted this business. If you believe this business is worth $15, fairness, I don't think it was. But if you think it was worth whatever it was, 2.x million a few months ago, 6 months ago, then this is a crazy cheap bargain. The question is, how over the top was it when it was worth?
What could make it halve?
Yeah, I don't know if it's
Answer
crazy
that question.
cheap. I think it have to go
Another
down a little
COVID?
bit more.
Yeah, COVID. What else? What could make it halve?
Oh, the Middle East conflict.
Well, I don't think it will.
Well, I think that's
there
still
already
good.
is a Middle East conflict.
Yeah. But I just like if that
world
gets
conflict
worse,
sort of
that
thing.
could start impacting
So
travel.
a world
That's
war.
right, yeah.
Okay,
Yeah.
no, that's
Yeah,
true.
yeah,
A world war,
that's
but
what-
unlikely, right?
It's anything that's going to stop travel is like yeah.
Well, anything, not just stop travel. So the way I think about it is
And
their price today is not dependent. It's not priced to perfection. It doesn't need to maintain some amazing
Not at all.
growth
Not even
rate.
close to
Yeah.
price.
And so if their growth dropped 2% on what people were expecting, I don't think the
It's not
price
gonna-
would
yeah,
halve,
yeah,
right? It's hard for me to think about something that could halve the stock price from here. And so I know like that's
Especially given the COVID resilience of the
Yeah, exactly.
subscriptions. Yeah.
And so I think if you're trying to say, this being a contrarian, which is what I'm saying, I would say if there's nothing that looks like a high probability or even a somewhat probability of halving the share price, like there's some risk of waiting for it to go down. There's some risk of buying before the facts are known. I think that's a line ball call because I think if the results are good in July, August, and they don't have to be very good, I think the market probably will re-rate this stock would be my guess.
Well, it feels like it's just unfairly tarnished with this SaaS apocalypse thing when this has nothing to do with SaaS.
Well, I'll tell you something that I really don't want this to be talking the Catapult book at all, but like Catapult released our results and a lot of them
Great results.
very well. A lot of them, thank you, a lot of them were very clearly communicated to the market. And I think a lot of what happened is it was just a reminder to people that said, hang on a second, these guys are not susceptible to AI. And actually, they just keep delivering on their commitments and
We were a
growing.
hardware business. I don't like it's
But
ridiculous.
I think what happened is they looked at it and said they keep delivering on their growth commitments and the money flows through to, we call it management EBITDA, you could call it cash EBITDA.
Yeah.
And so, and I think there was nothing that was especially amazing. They were good results, but they were telegraphed, right? And so I think that what the market is looking for from software companies is a reminder that the world is not ending for them and they will continue to grow and generate profitability.
That's happy. Even look at it last year, which is probably the most susceptible to disruption, or not the most, but it is susceptible to disruption. And that had a great result ostensibly a great result, but people didn't really believe it because disruption hasn't come yet. So I'm not sure one result cures these guys' ills.
Have you vibe coded Jira yet?
We're working on it.
But I agree. But I think that when
It's not top of the list. There's other stuff going
when
on.
they produce results, if they produce results at the end of this fiscal year that are just consistent with consensus, the market will remember, hang on a second, what the hell were we selling this off as part of the SaaSpocalypse for? That's all you need is just a reminder that delivering on your commitment with consistent growth and money flowing through to profitability
I think when it
is
makes-
what you want to buy.
This business could be making 20 million cash EBITDA calendar year this year, or even more.
This year,
calendar year, not financial
calendar year, yeah.
And if you make, and then you can extrapolate that's 40 next financial year, whatever it is. Like
Definitely in that ballpark.
This feels like we're bizarrely. This is a perfect inflection point now. You can see it in the last go from 13 to 4, basically break even. Forget that.
Yeah.
I agree with you. Forget the capitalized stuff.
Their NPAT is a lot
Beyond
of software
real.
companies,
Yeah.
like Catapult, you can't use the NPAT because of a whole lot of acquisition
Depreciation.
stuff.
Yeah.
Basically, like unfortunately, it's how we pay for acquisitions.
Yeah.
And it flows through the profit and loss. But like they don't have those problems.
And also-
You can believe their NPAT.
And their depreciation, so amortization was equal to their R&D cash spend. So that they don't get that, if the timing's off, you get that free hit. They don't get that free hit. So the NPAT's a very genuine
Well,
number.
I just want to pull you up on that. Their R&D amortization was not.
It was. I checked it.
Their overall amortization was.
Oh, okay.
But the R&Ds, they are spending more, but that's normal, right? Like I'm telling you, they're spending more in R&D. Take my word for it. But I'm okay with that, because their R&D spend as a percentage of revenue was falling. Now it's kind of flat, rising a little bit. I'm fine with
But
that.
regardless, and it's going to have to drop eventually, but regardless of that, like this is a business that will be profitable. We all think it's going to be profitable
we agree.
soon. And when it starts delivering 20, 30, $40 million profits, this is going to re-rate really quickly.
The growth, and the growth as well.
Yeah, plus the growth, plus it's in a great sector that's benefiting from lots of tailwinds.
I think to your comparison to Atlassian, I think the fair pricing, reasonable pricing kind of matters as well. Like pricing matching the performance really matters in.
Well, Atlassian was never making money as well, so it's really hard to. It's starting to now, but like that's the problem. You couldn't give it an EBITDA multiple because there's no EBITDA.
Be close to, yeah.
Well, that's the thing. Like, this is what breaks my heart with. I'll just say this for 2 lines, but when Catapult buys stuff, let's say we pay 80 mil for something, and we announce that, and it says, oh, cool, they paid 80 mil for it, as an example. But we won't pay the 80 mil unless the founders keep working. Maybe we'll pay 40, and the other 40 is contingent on them staying in the business. That means that other 40 flows through the income statement as an expense. That is the dumbness of accounting.
Yeah, exactly.
And so people look at that and they're like, the NPAT's going backwards. It's like, well, if you make our NPAT go backwards, you got to say that we bought the business for less, because it's just the purchase price flowing through versus hitting the balance sheet if we would have been dumb enough to pay it all up front.
Yeah.
And so that sucks, right? And it means it's hard to value Catapult on a PE because that negatively affects our NPAT because of accounting. But these guys don't have these problems. And what they've done is we're transitioning from giving them a revenue multiple to an NPAT multiple and a PE. That's the best transition you can have. That's how you should value a business.
Yeah, well, it's
and
best for investors for sure.
That's what's happening here, right?
Yeah.
So I think definitely we all agree no one is shorting this thing.
I don't think a 40 valuation, an NPAT 40 is unfair for the business's growth, of this kind of level of growth. It's growing at 25, 30%, super sticky revenue, very low, in the context of things, very low risk.
So all we're arguing about between the three of us really is it a good buy today? Do you want to wait for more information before? No one's saying short it. Like, I think we finally found something that we're not saying short this thing. Like,
well, I was bullish on line bikes. You were the bear on that. After your network effects.
I did. You know what? The thing is this: you got to give yourself some credit. Like, you actually remember you persuaded me to be much more positive about the business. I'm not sure about the valuation, but like, you made me much more positive about the business from our discussion.
Yeah, well, both. I think you look at this business, this SiteMinder business. It's bizarre that the market's written it down when it's actually looking the best it's ever looked. It's just so strange. Like, the market is so irrational. We talk about it all the time, but this is like the height of rationality. It gave it this huge valuation at $2 billion when it wasn't doing that well, and now it's doing really well, about to start making lots of money. And this could be making $100 million in a few years' time, and then you give it a 20, 30, 40 multiple. It's $2, $3, $4 billion business. We're not miles off that.
Just to give you one thought that's been going on in my mind around the SaaS apocalypse is like, there's an element of, now it is sensible. If you think back to 2 years ago on the podcast, you got everything you guys looked at. We
couldn't find the thing we liked.
You're like, that is crazy pricing. And now more and more, there's things where we said
Xero was a great business. We said, why it's a great, the valuations were completely batshit crazy. Yep. And now they've dropped 70%. They go, not too bad. Like, like, I'm not rushing out and buying Xero now because I don't like the management, but like, valuation-wise, it feels pretty good.
You can buy SiteMinder today at the price that was paid in 2019.
Yeah.
And it's an incredibly
better business
today.
Well, it barely had a transactional business back. It had a little transactional business, but it was small.
And it has much more revenue.
It's about half the revenue or less.
And it's heading to break even. It's going to pass through. Yeah, I think, there you go. You finally, who picked this one? You?
Scott? Yeah.
Oh, you finally picked a good business for us to talk about.
I'm actually a buyer of this business at this price.
Are you? There you go. I think you're waiting for FY26
you're
results or
not?
I think it's a great business.
Yeah.
What's your answer? You've got to commit to something.
Oh, yeah. I'm a buyer.
You're a buyer at this price?
You're a buyer. Don't we get three ringing the bells?
Yeah, I would buy at this price. Not investment advice.
Of course not. That was a great episode. Thank you, Scott, for not only coming in, but for such a great Australian business that's done so well. We love looking into it. Thank you, Adir. Of course, we'll be back for our big episode on Tuesday. Love having Scott in. So I think our audience prefers you to us, so which is a bit
They definitely prefer him to you.
Yeah, that's true.
That's a feedback I'm getting.
My mum certainly does.
Oh, don't you? You're meant to fight back. Why you don't fight back? Now, pummeling someone who just lies down is not fun. You got to punch back.
I do during the episode.
So no one would even notice if you didn't turn up, Adir.
I noticed. My mum certainly would.
N equals 1.
Thank you, guys. We'll see everybody on Tuesday.
Thank you.